Welcome to Capital Explained, where we break down the financial forces shaping your future. Make sure you're subscribed so you never miss what matters next. On January 27, 2025, at 11:42 a.m. Eastern Time, a portfolio manager sitting on the fixed income desk at BlackRock in New York received a sudden alert on his Bloomberg terminal. This was not normal market movement. It was not triggered by inflation data, employment numbers, or a GDP report. The volatility came from politics. Within less than a minute, futures linked to expectations for Federal Reserve policy repriced sharply. The cause was a rumor that had leaked from a meeting connected to the incoming administration of Donald Trump the previous night. The discussion involved who might replace Jerome Powell when his term as Federal Reserve Chair expires on February 2nd, 2026. The name circulating in financial circles was Kevin Warsh. For most people, that would sound like a routine leadership change, but inside global finance, it was a potential shockwave. The portfolio manager immediately forwarded the alert to his chief investment officer with only one word in the subject line: problem. This situation is not simply about who leads the Federal Reserve. It represents a possible clash between the direction of the world's most powerful central bank and the positioning of the world's largest asset manager, which oversees roughly $10 trillion in client assets. What we know for certain: Jerome Powell's term as chair legally ends on February 2nd, 2026. That is established law, not speculation. Powell was first appointed by Donald Trump in 2018 for a 4-year term and was later reappointed by Joe Biden in 2022 for another 4-year term. Although he can remain on the Board of Governors until 2028, the chairmanship itself will become vacant. The chair is the most influential position in global finance. This person leads Federal Open Market Committee meetings, testifies before Congress, and moves markets worldwide with every statement. Trump historically had a complicated relationship with Powell. After appointing him, Trump repeatedly criticized Powell during 2019 and 2020 for not lowering interest rates aggressively enough ahead of elections. The president could not legally fire him due to central bank independence, but dissatisfaction was clear. Now, because Powell's term ends during Trump's second presidency, Trump has another opportunity to choose a chair. Most analysts and insiders believe Trump prefers a new leader, someone younger, more aligned with his economic views, and more willing to cut rates when stimulus is desired. The candidate most frequently mentioned is Kevin Warsh. Why Kevin Warsh matters. Kevin Warsh previously served as a Federal Reserve governor from 2006 to 2011 after being appointed by George W. Bush at just 35 years old. He was present during the 2008 financial crisis, participating in decisions involving the Bear Stearns rescue, the Lehman collapse, the AIG bailout, and the first rounds of quantitative easing. After leaving the Fed, Warsh joined Stanford's Hoover Institution and continued writing and advising on economic policy. Trump had already considered him for Fed chair in 2017, but ultimately chose Powell as the safer option. Warsh's economic philosophy is crucial. He is widely viewed as an inflation hawk. In other words, he prioritizes price stability even if unemployment rises. He has long argued that interest rates were kept too low throughout the 2010s and that quantitative easing distorted financial markets. In a 2013 article, he described QE as monetary morphine, warning that it would create long-term damage. When inflation surged in 2021-2022, Warsh was among the loudest voices claiming the Fed reacted too slowly and should have tightened policy earlier and more aggressively. Powell eventually raised rates rapidly, from near zero in March 2022 to over 5% by mid-2023, bringing inflation down from around 9% to roughly 3%. But Warsh's view is stricter. Keep policy tight until inflation is completely defeated, even at the cost of recession. Temporary economic pain, in his framework, is preferable to long-term inflation. BlackRock's positioning. While these political discussions were unfolding, BlackRock had already positioned trillions of dollars based on a different expectation. The firm manages money for pension funds, sovereign wealth funds, insurance companies, and retirement accounts worldwide. Asset values, stocks, bonds, and real estate depend heavily on interest rates. Low rates raise valuations. Stocks trade higher, bonds gain value. Real estate becomes more affordable. Asset managers earn more fees. High rates do the opposite. During 2023 and 2024, as inflation cooled, BlackRock prepared portfolios for eventual rate cuts. They increased bond duration, meaning they bought longer maturity bonds that would rise in value if rates fell. They kept strong equity exposure, expecting a rally, and reduced cash holdings, anticipating declining yields. This strategy only works if the Federal Reserve eventually eases policy, something Powell has repeatedly signaled to avoid unnecessary economic damage and achieve a soft landing. But if Warsh becomes chair, the scenario changes dramatically. Warsh would likely keep rates high until inflation reaches the 2% target decisively. Rate cuts could be delayed for years, not months. That would hurt long-duration bonds, pressure stock valuations, and undermine the positioning built around easing expectations. BlackRock has not publicly admitted such a bet, nor would it publish political forecasts. However, its disclosed portfolio allocations strongly imply expectations of a moderately dovish Fed, not an ultra-hawkish one. Either the firm miscalculated, or it did not anticipate someone like Warsh leading policy. The timeline: the Fed chair selection process involves nomination by the president, hearings in the Senate Banking Committee, a committee vote, and finally a full Senate confirmation. Typically, this takes 2 to 3 months. Since Powell's term ends February 2nd, 2026, the nomination would likely occur months earlier, around spring 2026. That is why the coming months matter so much. The decision will determine interest rates, mortgage costs, investment returns, and retirement portfolios worldwide. This is not merely a leadership change. It may become a collision between monetary policy philosophy and trillions of dollars positioned for the opposite outcome. If the president wants a new Federal Reserve chair to take office immediately after the current term ends, the nomination would have to come early, likely November or December 2025. Senate hearings would then occur in January, followed by confirmation near the end of January or the beginning of February. In that fast-track scenario, the transition from Jerome Powell to the next leader of the Federal Reserve would appear seamless. However, appointments under Donald Trump have historically not always moved quickly. A more realistic timeline is that the nomination happens after Powell's term expires, sometime in January or February 2026. If that occurs, Powell could temporarily remain acting chair, or the vice chair could lead until confirmation is complete. In that slower process, hearings would likely take place in March and the Senate vote in April. The new chair would then be confirmed in late April or early May. That places May 15th right in the middle of the expected window, almost exactly 100 days after Powell's term ends, a symbolic transition period. Regardless of the exact date, one outcome is almost certain. By mid-2026, the Federal Reserve will have a new chair, and if that person is Kevin Warsh, markets will rapidly adjust. Immediate market reaction. Within hours of Senate confirmation, possibly by a wide margin such as 65-35, financial markets would react. Bond yields would jump first. The 10-year Treasury yield, currently around 4.3%, could rise toward 4.7% or 4.8%. Investors would immediately assume interest rates will stay high for longer. When higher rates persist, existing lower yield bonds lose value, so yields rise to match the new expectations. Stock markets would also decline. Not a crash, but a noticeable drop. The S&P 500 could fall roughly 5 to 7% in the first week. High valuation growth stocks, particularly technology companies, would suffer the most because their pricing depends heavily on low interest rates. If a company trades at 40 times earnings and interest rates rise, investors may only pay 35 times earnings. That alone produces a decline of around 12%, even without any change in profits. The US dollar would strengthen. Higher interest rates attract global capital into American assets. While this benefits travelers and import buyers, it hurts exporters and creates pressure on countries carrying dollar-denominated debt, such as Turkey or Argentina. Mortgage rates would rise as well. The 30-year mortgage follows the 10-year Treasury yield plus a spread. A jump from 4.3% to 4.8% on the 10-year could push mortgage rates from about 6.8% to roughly 7.3%. For a $400,000 loan, that increases monthly payments by about $150, nearly $1,800 annually. Worsening affordability in an already strained housing market. Impact on retirement portfolios. Many retirement accounts hold balanced funds with a 60-40 allocation, 60% stocks and 40% bonds. In a Warsh scenario, both sides are hit simultaneously. Stocks fall due to valuation compression, bonds fall because yields rise. A typical balanced portfolio could drop 5 to 8% within the first month after confirmation. A $500,000 retirement account could lose $25,000 to $40,000 purely from changing expectations, not from recession or corporate failure. The world's largest asset manager, BlackRock, oversees trillions in similar portfolios. If client portfolios decline around 6%, that implies roughly $600 billion in paper losses across $10 trillion under management. Those losses do not directly bankrupt the firm, but investors notice. Withdrawals begin. To meet redemptions, assets must be sold, which pushes prices lower and can trigger further withdrawals, a negative feedback loop. This would not necessarily create a crisis, yet it represents the worst-case environment for portfolios built on expectations of rate cuts. Other major managers would face the same challenge, but BlackRock's size makes the impact most visible. Possible responses from asset managers. They have three choices: reposition early, sell long-term bonds, hold more cash, and shift toward value stocks. The risk is being wrong if rates actually fall. Wait until confirmation, but by then markets already moved, forcing them to sell low and buy high. Hedge positions. Use options and derivatives to limit losses, though hedging reduces returns. In reality, they likely combine all three, yet moving trillions cannot happen quietly. Large trades themselves move markets, the unavoidable cost of scale. Historical perspective. Central bank leadership changes have reshaped markets before. In 1979, Jimmy Carter appointed Paul Volcker to crush inflation above 10%. Volcker raised rates near 20%, causing deep recession and unemployment above 10%. Inflation fell dramatically, but the economic pain was severe. Warsh is not Volcker, and today's economy is different, yet the philosophy is similar and prioritize inflation control over short-term growth. Markets fear uncertainty about how much pain may follow. Another example occurred in 2006 when Ben Bernanke replaced Alan Greenspan. The transition, coinciding with the housing bubble collapse, amplified uncertainty during the financial crisis. Leadership style mattered as much as policy itself. History shows markets react strongly when central bank philosophy changes. Practical financial steps review asset allocation. Long-term bonds are vulnerable if rates stay high. Short-term treasury bills or money market funds adjust faster. If planning to buy a home, understand mortgage rates could rise. Locking a rate early might help, or waiting could improve negotiating power if housing weakens. Consider refinancing variable rate debt into fixed rates before borrowing costs increase. Diversify stock holdings. High-growth tech is rate sensitive. Value, dividend, financial, and energy sectors handle higher rates better. Build emergency savings, ideally 6 months of expenses, to avoid selling investments during volatility. Watch the nomination announcement closely as markets react immediately. The bigger picture. For more than a decade after the financial crisis, policy remained extremely supportive. Low rates, quantitative easing, and frequent intervention. Investors came to expect a Fed put. The belief markets would always be supported. Warsh's philosophy rejects that idea. His focus is price stability, not asset prices. If policy stops cushioning markets, that represents a structural regime shift. Regime shifts transfer wealth. In the early 1980s, high inflation hurt savers and benefited borrowers. After Volcker's tightening, the opposite occurred. Savers gained and borrowers struggled. A similar transition could move advantage from speculative assets towards safer income-producing assets once yields stabilize. Final thought: Warsh may moderate once in power, or another candidate may be chosen. A more dovish chair would support markets and validate current positioning. Yet given political preferences and past relationships, Warsh remains a realistic possibility. The key point is not the exact date, but the direction of policy. If monetary policy shifts from easy money to persistent tightness, portfolios built for falling rates will struggle. Understanding that possibility now allows preparation rather than reaction.